Well, I think we're ready to get started for this deep dive. I want to say welcome to everybody joining from all over the country as we get started this Monday, March 18th. Looking forward to this deep dive. If you saw the announcement, we're going to talk about foreclosures this morning. So we will dive deep into foreclosures. I'm going to hit a little bit of equity as well, and we'll talk about that. But as you're joining, let us know where you're watching from. It's always so good to see people from all over the country that join the deep dive each Monday morning and get their week started talking about some of the biggest topics in real estate and really becoming the educator and becoming the source of knowledge on those topics. So as always, let us know where you're watching from. I'm following along here as well and hopefully can keep up from that. Lee, see you there. From LA, great to see you, Francisco and Palm Springs, Dennis and Rochester. Great to see everybody there that's joining this morning. Roger in Illinois, great to have you on. We're going to talk about foreclosures, spend a few minutes on that topic, taking sort of a deeper dive down into that topic. You know, it's a topic that is a fact in our business and one that we need to be the educator on. Julia, see you there in Miami. Great to have you on this morning. Jill, good to see you. So many folks from all over the country joining the deep dive. You know, as we get started, I want to say a couple of things too on this Monday morning after Friday's NAR announcement. We're not going to go deep into that. There is plenty of information out there, and I know everybody on here has seen that. But I want to maybe give you a few things to think about this Monday morning. Three things that I'll guarantee you. First of all, consumers are going to still and are anxious to buy and sell homes in this market. Matter of fact, there's not a market across the country that would say, you know, they have enough homes for the number of people that want to buy them. And we know that is a fact. Second, I will guarantee you this, buyers and sellers will pay for advice. There is no doubt about that. They will pay for the agent and the expert to navigate them through this process, and we certainly know that if we're in the business. Third thing, I'll guarantee you, there are a lot of people that are focused on things right now they can't control, and my coaching to you this morning is to focus on what you can control, and that is being the expert, being the knowledge broker on the topics that matter, and really being the source of knowledge. I believe this is a market that people want to know, clients want to know that you understand what is happening. There is no doubt that they want to know that, and they want that advice for you. So plenty more information will come out about that. So many good folks to see all across the country joining this morning. Great to see everybody on, and we're going to get this deep dive started here in just a minute. Let me put my iPad over to the side because I'll end up watching everybody joining. So here was the topic that we wanted to jump into this morning. Will foreclosures be a challenge this year? So here's what I'm going to do over the next few minutes. I'm going to give you some of the most up-to-date information on this topic that you can then use as you have conversations, because it's a question that comes up. You know, if you followed Keeping Current Matters, we've talked about the Freddie Mac survey that's done every month where, you know, somewhere between 20 and 25%, maybe 1 in 4, 1 in 5 consumers believe home prices will go down over the next 12 months. A lot of that is a belief that we could enter a market where people are going to get foreclosed on. And when you start to look at the data, you start to look at the facts, it couldn't be further from the truth. So give me just a moment here as I share my screen, and we'll hop into this topic and get started. As always, if you're a KCM member, you can go in and download all of these slides from the member area and have this information, some great information you can post today as you be the knowledge broker on this topic. So share this real quick with you. Adam Data, you know, the leading source of this type of information. It says, Adam, a leading curator of land, property, and real estate data, today released its February 2024 foreclosure market report, which shows a total of 32,938 U.S. properties with foreclosure filings default notices, scheduled auctions, or bank repossessions. We'll call those distress sales. Down 1% from last month, but up 8% from a year ago. As we always say, headlines do more to terrify than clarify, and this will generate headlines that terrify people to say foreclosures are up 8% from a year ago, right? And that causes sort of fear and panic inside of buyers' minds. What does that mean? What's going on here? And it sort of, precipitates all of these titles on headlines and maybe in news sources of, foreclosures are rising. There's a deep recession. Is your home safe? Is the equity in your home safe? And we'll talk about that in just a minute. If you were last week on the Keeping Current Matters webinar, the spring market update, I went through this, and this will be the second time around for you. A couple of new pieces of information that I didn't include there. But this is a topic that we have to stay on top of, and certainly one that I believe people are interested in. I'll take you back and remind you of one thing as we sit at foreclosures right now. Last year, foreclosure activity actually, rose just a little bit. If you look at this in 2023, there were just over 357,000 foreclosures in this country, over 324 the year prior in 2022. But ever since 2010, foreclosures have been on the decline. Now, here's what's interesting about this. I used to make the joke that apparently when you qualify someone well and you qualify somebody for a mortgage, they don't default, and that certainly is true. The more stringent qualification standards came about as part of Dodd-Frank, which the qualified mortgage came about then, and certainly said you have to have assets, you have to have verifiable income, all the things we know about a mortgage today. And that pendulum swing coming out of 2008, where that was not the case. What's the other thing that came out of Dodd-Frank? I want to remind everybody on the call of this. Loan officer compensation came from as a part of Dodd-Frank as well, and a lot of changes to loan officer compensation. Certainly not. I'm not comparing the two, saying they're equal, but there was a compensation element to that as well, which is what we're dealing with now, and a lot of reaction to that right now. But foreclosures up slightly last year over the prior year. And let's put this into perspective right now where we sit in this country. Activity has increased from 2022. That was the last full year before 2023, obviously. But way below pre-pandemic levels. Back in 2010, the red bar to the left, 2.23 of all U.S. housing units, 2.23% were in some type of distressed sale. And what we see pre-pandemic, that number 0.3%, then coming out of the pandemic, even lower, right? And there are a lot of reasons for that. One of the reasons that I'll get into in just a minute is the enormous amount of equity that people have in their homes across the country, which, if they're in that situation, can then have options as to what they would do. But these types of topics come up and people think, you know what, there's no way the home down the street maybe is worth what it seems like it's worth. And if they're inflated values, that means prices are going to come down. That means people could get foreclosed on. That means people would be underwater. But Black Knight said this, probably one of the best, in tracking this kind of information along with Adam data. The prospect of any near-term surge in foreclosure activity remains low, with start volumes, that's foreclosure starts, still nearly 40% below pre-pandemic levels. So if you take anything away from this call, we see less foreclosures in the market right now than we even did before the pandemic. A lot of that is due to a well-qualified borrower. A lot of that is due to the equity that people have in their homes. A lot of that is due to the different decisions that people have made about making wise decisions in their housing over the last 10 years, the way they've protected equity, the way that they've looked at a fixed rate mortgage versus an adjustable mortgage when you see those things shift like we did in 2008. And a lot of people got in trouble there. But the fact of the matter is, when we think about this topic, is the reality is there have been over 1 million fewer foreclosures in the last 5 years than the years prior. You see it right there in sort of the middle of the screen, almost 1.5 million fewer foreclosures in the last 5 years. And the reality is, if those did come into the market, they would be snapped up very, very quickly. No doubt, people on this call right now, people that say, okay, we're going to sit on the sidelines and we are going to wait till a foreclosure comes on the market. Well, if you're sitting there waiting, or you have a client sitting there waiting, I've got bad news that's not coming. And, again, I talked about this topic being something that is maybe a fact in our business, but I'm not saying it's not a crisis for the family or the individual that's going through it. But today is very, very different than what we saw in 2010. If somebody were to end up in a situation or a financial crisis where they had to, do something in their housing or step away from their housing, people have equity. They have options. They can, pay a commission. They can sell their home and put a little bit of money in their pocket as they move from maybe one side of the crisis they are facing, to the other. And that's a good thing. We want that for them ultimately. But as we start to look at foreclosures, while, a headline may say, hey, they're up month over month or year over year, or slightly down month over month, but up year over year, the reality is all foreclosure metrics right now are down as of December to the previous year. Active foreclosure inventory is down, foreclosure sales are down, foreclosure starts are down. And that's something that we want to be vocal about, something that we want to give people the information that they need to go out and make a confident decision. Again, if 1 out of 4 or 1 out of 5 people believe home prices are going to drop, a lot of that's tied to maybe we're going to see this flood of foreclosures, to educate them and say, you know what, this is the reality in our business right now. Bill McBride, who's the author of the Calculated Risk blog, he called 2008 back when that happened. He said this, he said, I've argued repeatedly that we would not see a surge in foreclosures that would significantly impact house prices, as happened following the housing bubble 2008. 2 key reasons are mortgage lending that has been solid, and most homeowners have substantial equity in their home. So I talked about, Dodd-Frank coming into the mortgage market, more stringent qualifications for a mortgage, compensation pieces there. I'll remind you of that. But what he's saying is, in that, you have a better qualified borrower that does not default as much. And oh, by the way, substantial equity in homes across the country. So I'm going to talk about equity here in just a minute, because I think that's a big component to this picture of foreclosures. But the one thing that became crystal clear coming out of the pandemic and in the years that have followed here is that people made different decisions relative to how they stewarded the equity in their home. Back in the financial crisis, back in 2008, people continued to borrow against their home, and maybe they had an adjustable rate mortgage, and they would harvest equity off that, thinking this will never end, and going out, living life, and buying a jet ski, going on vacation, whatever the case was. And we know how that turned out. And many people said, I'm going to do it different today. Maybe they saw a family member hurt. Maybe they were hurt. Maybe they lost their home. They saw somebody lose their home. And they said, you know what, I'm going to do something different with my equity today. So let's talk just a minute about equity. I think this is a topic that we can get out in the market and be vocal about that. Today and this week, we can get information out there to say this is what's going on with equity. And so I pulled a couple of things. Our research team is so good at finding these great nuggets of what exactly is happening. First one from CoreLogic. Home equity gains continued in the fourth quarter of last year, providing owners with a solid financial cushion, particularly for baby boomers who have been in their homes for a while and thus accumulated substantial equity. So fourth quarter last, information available year over year, and said this, CoreLogic said this: the average U.S. borrower saw equity increase about $24,000 year over year in the fourth quarter of 2023. If you have your phone out right now, I would take a picture of that. I would then post it. I would get it out there. because that is a number that people go, wow, that's amazing. One of the biggest things that has been working, if you've been paying attention out in the market, is engaging people on this equity topic. Do you know how much equity you have in your home? Did you know that in the last year, the average U.S. borrower saw equity increase by about $24,000? On a post last week that I made, it was on LinkedIn. I used the next slide about the difference between a homeowner and a renter in home equity. And the numbers are shocking. This is another perspective that, I think we need to be vocal about. Many of you have, but the net worth of a homeowner versus a renter, homeowner just over $396,000, almost $400,000, the net worth of a homeowner as compared to a renter, just over $10,000. Now, it makes sense for some people to rent and lifestyle choices, and maybe whatever they have going on, owning a home at this point is not right for them. But there is one fact that is undeniable about home ownership. It is the number one way that people build wealth in this country. It's the number one way that people are able to maybe send a child to college, or to start a business, or to have money to retire on. Truthfully, number one wealth builder in this country is owning a home. And depending on the state that you're in, you can see right here, I'm in Virginia. Homeowner equity gains year over year as of the fourth quarter, $32,000. Go out there, $49,000 in California. You see all over the country what that is. So, if I was talking about this today, I would say, hey, we're here in, we call it Georgia. It's where I grew up, in a little town in Georgia. $25,000 on average home equity was gained in the last 12 months. So when we start to think about this foreclosure topic, and we see the amount of equity that people have in their homes, there is a reason people aren't foreclosed on. They have options today, and that is a very, very good thing. And the bottom line is, and if you've followed Keeping Current Matters, you've seen this graphic. It's been updated. We update all of these graphics. This next one that I'm going to show you, we update them on a frequent basis when new information comes out. But the bottom line is, in this topic, Americans are sitting on a tremendous amount of equity. 67.4 either have their percent of Americans have their mortgage paid off, or have at least 50% equity. They're termed equity rich. Think about that. It's a tremendous amount, a tremendous advantage for homeowners in this market, a tremendous opportunity even going into the coming years. One thing that I do believe is that equity will be put to work. It's just a matter of how. Maybe somebody buys a second home. Maybe they move up. Maybe they downsize. Whatever the case is, they will put that equity to work in the years to come. I'll wrap up on this, because I think the foreclosure topic, the equity topic are linked together, and they're linked together because of rising home prices. Selma Hepp does phenomenal work at CoreLogic. She says this: rising home prices will continue to fuel growing home equity, which at $298,000 per average borrower remain near historic highs at the end of 2023. By extension, at 43%, the average loan-to-value ratio of U.S. borrowers has also remained in line with record lows, which suggests that the typical homeowner has a notable home equity reserve that can be tapped if needed, right? If you have this reserve, you can tap it if you need it. You can get access to that cash if you need it. I will tell you this as we wrap up here on the deep dive this Monday morning. This topic is the number one topic that we get questions about. I had the chance to share the KCM message with a group a few weeks back, and one of the questions they sent in was, will you address this? And somebody had asked, do you see the return of a foreclosure market, or a market where home prices are going to go down because of this? There's a lot of uncertainty in the market. There's a lot of uncertainty today across agents, no doubt. My advice, my coaching to you is stay committed to being the knowledge broker. Stay committed to delivering the facts. Okay. And that's our aim on the deep dive. It's everything that we do at Keeping Current Matters. Last week we were on and we celebrated Steve. And Steve's impact will be for forever, will change the real estate business. But he was passionate about this, saying, calm down, sit down, think, plan, and act. And that's what we need to do right now. Take the information we know, stay focused where we need to go, and no doubt we'll be able to make a difference that way. We'll be back next week with the deep dive, talking all about inventory and what's going to happen in the spring market. So I hope you'll join us for it. Share this deep dive with somebody that you know needs to hear this information so that they can be out in the market and be the knowledge broker just like you. So thanks for joining, and we'll see you back again next week. Take care.